Hello, I'm Greg Hansen, Managing Director of Investments for Legacy Private Trust Company. And with me today is Connor O'Brien, who is one of our portfolio managers here. Today, we're just going to give a little bit of an update on what we see in the markets and the economy through July of this year. So first half of the year, markets and the economy, we'll have a recap. Connor will cover that. We'll talk a little bit about sector rotation that we're seeing. One sector giving away and letting other areas come in as strength. And then he will talk a little bit about peak growth, peak earnings, and peak policy. From there, I'll pick it up and talk on inflation, the taper timeline for the Fed and what we're expecting on that front, and then what the market is telling us. So with that, I'll turn it over to Connor, and he can tell you about the equity market performance.
Thanks, Craig. So there's no beating around the bush. When it comes to the equity markets, it was a really, really solid first half of the year for pretty much everything. For foreign, for domestic, for value, for growth, for large cap, for small cap. The list of tailwinds was really long. You had easy monetary policy, you had central bank liquidity, you had excess savings from the fiscal stimulus, you had pent-up demand, you had upside earnings surprises, buybacks, retail involvement, operating leverage, the list goes on and on. The blue bars here on the left are showing your sector returns for each of the sectors of the S&P 500 for the first 6 months of the year. And on the right-hand side are some of the major indices. The S&P 500, which is the fourth set of bars from the right there, it finished the first half of the year with a total return, and by total I mean it includes dividends, of a total return of 15.25%. That would be its second best first half of the year since 1998. A few other notable highlights: we've had 5 consecutive quarters positive for the 3 major indices, going back to Q2 of last year, of course. S&P 500 earnings have fully recovered from pre-pandemic levels in the first quarter to hit record highs. And we're about a third of the way into Q2 earnings season, and this quarter is looking even better than the first quarter. And for the first half of the year, every sector finished positive, so you saw broad and healthy market participation. Now, if you look at the gray columns on this page, we'll talk a little bit more about this on the next slide, but you can see that we've had a little bit of an unwind of the reopening trade, or the cyclical trade. It's also called. The areas of the market that worked really well for the first half of the year, energy, materials, financials, small caps, those have faded here a bit to start the third quarter. And if you flip to the next slide, slide 5, you can see there's been a little bit of a changing of the guard in terms of market leadership here. So this has been one of the big stories to start the quarter. What we're looking at here are returns for the S&P 500 in blue, the value stocks within the S&P 500 in purple, and growth stocks within the S&P 500 in green. So it's important to remember that when economic growth is expected to be strong, you would expect your value stocks, and by value stocks, I mean banks, industrials, materials, energy, you would expect those to outperform growth. And by growth, I mean technology, healthcare, consumer discretionary healthcare. So the reason being that the price of a stock is generally just a discounted present value of all the future cash flows that company will produce. So what makes a growth stock is the fact that they have relatively low earnings today and cash flows today, but they're expected to grow those earnings and cash flows in the future. So you're paying what is usually a high multiple now for growth that is expected to happen years down the road. Zoom technology, for example. A value stock, on the other hand, is usually a more mature, a more cyclically sensitive stock that's growth is highly linked to GDP. So Caterpillar is an example of that. Since the reopening of the US economy was a lot quicker than a lot of people expected, and this really started back in February as the vaccination campaign ramped up, investors, they sat back and they said, well, wait a minute, why would I pay a huge premium for a growth stock when I can buy a value stock that trades at a much more reasonable valuation, probably pays a higher dividend and should grow just as fast as that growth stock. And so that's exactly why you saw a huge divergence in value and growth earlier this year. Everyone rotated into value and out of growth, but you'll notice that in late May and early June, this rotation stopped and it reversed. So what happened then? Well, a few things. One, you started to see concerns about a peak in earnings growth and a peak in GDP growth, and we'll talk about that more later on. And that peak in GDP growth obviously has a more direct impact on value stocks like we talked about. We also started to see a resurgence in COVID-related news, specifically around the new Delta variant, which also is expected to put a little bit of a tamper on economic growth expectations in the second half of the year. And third, we saw a big fade in interest rates, especially after the June Fed meeting. And lower interest rates benefit growth stocks because, like we said earlier, their long-term future cash flow growth and earnings potential are discounted now at lower interest rates. So we've seen growth take back the reins here from value. This will be worth watching in the second half of the year. And if you're just looking at the blue line, the S&P 500, you're missing a lot of the push and pull that happens underneath the surface of the markets. That's important to pay attention to. Moving on to slide 6. So you're starting to hear analysts, and especially macroeconomic analysts, refer to the second quarter as the peak everything quarter. And what they mean by that is that we are most likely going to see a peak in 3 things. The first, earnings growth. And you can see that in the chart on the top left there. We're looking at earnings growth of over 75% in the second quarter of this year, which will probably be a peak in earnings growth. We're also expecting to see a peak in quarterly GDP growth here in the US, which we'll get that number this upcoming Thursday, and expectations are for close to a 9% annualized GDP growth number for the United States here. And then third, we're expected to see a peak in fiscal support. Obviously, we've seen massive fiscal support over the past 2 years. That'll inevitably fade as COVID-related stimulus rolls off. So it's important to note that analysts and economists aren't saying that earnings and GDP growth itself has peaked. It's just that the growth rates should decelerate from really high levels, which should be expected. You obviously can't keep up 75% earnings growth and 9% GDP growth for the long haul. That's just not sustainable. It's just the natural course of the business cycle where the economy has snapped back, growth has rebounded really, really quickly, and then it'll taper off into what is a lower, but hopefully still positive earnings and GDP growth. So you'll hear peak growth among investors' list of concerns right now. It really shouldn't spook anyone out of the market. This is probably as fast as GDP and earnings will grow for the foreseeable future, but that doesn't mean that growth can continue to be positive moving forward from here. So with that, I will pass it back to Greg to talk about inflation and Federal Reserve.
Sounds good. Thank you. So I think one of the things that comes to mind here is as we're seeing peak growth, that's led to some imbalances in the economy. Most commonly a supply and demand imbalance in things like labor and parts shortages, and then that has triggered some outbreaks of inflation. The Fed has commented on this recently. Their latest positioning is that they expect the inflation outbreak to be transitory or last for some short period of time. But I think anytime there's an inflation outbreak, people tend to get nervous that it's going to continue. We've only been in this for a couple of months, and the Fed, I think, is still comfortable. But I'm getting a sense that a lot of people, our clients and among them, have been concerned by the level of inflation that we're seeing here. On the right-hand side is the headline consumer price inflation that encompasses all goods and services in a basket that the government's defined. And then on the left side is the core, which is essentially the same thing, but excluding food and energy prices because they're a little bit more volatile. And on both graphs, you see a spike on the right-hand side the last 3 or 4 months, like I mentioned. When you look through each of those, the colors in the stacked bars tell a little bit more of the story. And I think this is an important thing to understand. Where the inflation is coming from is not entirely related to this, but it's largely attributable to 2 things. One being vehicle-related cost increases. So whether it's new car prices, used car prices, parts for vehicles, rental cars. Rental car companies decreased their fleets a number of months ago when the pandemic hit and nobody could travel. Now they're having a hard time buying vehicles. And the supply of new vehicles is really kind of limiting this as well because there's a shortage of computer chips. Think back to the way cars used to be made 20 and 30 years ago. There was a lot of steel and a lot of nuts and bolts, but today there's a lot more computer chips in them. And so once that supply-demand imbalance in computer chips works its way through the system, we think that this will be a transitory thing. Vehicle prices will come back to normal levels. The other issue that we're dealing with currently is a shortage of labor, which is hitting the airline and the hotel travel types of industries very hard. Meeting with restaurateurs earlier this morning who were saying that similar story to what you've heard on the news, I'm sure, they're just not able to find labor to fill all the shifts that they have. And so they're either closing on certain days or they're increasing the wages that they have to pay. All of those things are inflationary by nature. But again, once the economy reopens, people have taken the trips that they've put off, they've bought the vehicles or repaired the parts that are broken on the current vehicles. We expect a lot of this to subside, which leads into the next idea here with the Fed and what we're likely to see from them. So, and we talked a little bit about this in our update last month, but this is what we're looking at in terms of the Federal Reserve and when we would expect to see them take action. I think some people may be looking for them to start raising rates, but we have to remember that they're still buying $120 billion per month of government securities. And so more than likely what we're going to see is at their annual Jackson Hole Symposium, which comes up at the end of August, we would expect them to announce that they're planning to start tapering purchases of bonds in the coming months, but not something that they're going to implement immediately, that there would be some lag time before they would go into a taper mode. Once they announce that taper, it'll eventually start to work its way through, and it's not something where they're going to stop buying bonds altogether. They're going to slowly cut back the pace of those purchases. And so two different sources estimate how that might look on the right-hand chart here, but sometime throughout 2022 that will likely play out, and the tapering probably will conclude late 2022, all else equal, and if certain factors don't change between now and then. In addition to that, once they get done tapering, they're probably going to pause for a while to see whether that's had any sort of an impact on macroeconomic activity. If it hasn't, they may continue to stay on hold and not do anything more, or they may announce that they need to continue to raise or begin to raise rates, which there again, we would expect they would announce something before they put a shock into the market about raising rates. And so that whole process is likely to take some time to play out. We don't see it happening. The first rate hike probably wouldn't be for about 2 years yet, the second half of 2023, based on what we know and what we see happening out there at the present time. So certainly not anything where the Fed is panicking on inflation. They, again, have said it's transitory and they're willing to watch it for a period of time. So with that as a backdrop, we think they remain accommodative, and that's a positive for equities. The last thing I want to point out is the yield curve. And so this looks at what yield you can expect to receive on various treasury instruments of different durations. The red line or purple line goes back to last year at this time, and you can see that the short end of the curve was a little bit higher than where we are today. The long end of the curve was lower, and from that point forward, we've seen a steepening of the curve, but the difference between the green and the blue lines here, the green was roughly a month ago, and the blue line is the end of last week. I think the important thing to note here, the scale is hard to pick up, but if you look at, say, a 2-year treasury, the blue line or current rates have risen in the last month, not a lot, but modestly. At the same time, the 10-year yields and longer have come down. And so the shape of that curve is getting a little bit flatter. Generally speaking, we like to see a steep yield curve where the front end is very low, the long end is higher. That's a good sign that the markets are anticipating future growth. And when we see an inverted curve, the short end higher than the long end, which obviously we don't have here yet, but an inverted curve is a sign that the Fed is trying to slow the economy and often that's a precursor to a recession. So we're still a ways away from that, but we are watching this. And if we do see continuing flattening of the curve, that in our mind likely means that the Fed is going to stay on hold a little bit longer so as to not trigger a recession. So that's the latest thinking from Legacy at this point. If you have questions or if you'd like any more information on anything we discussed here, please contact marketing@lptrust.com. Thank you for watching.